Welcome to Multiple Perspectives. This is your weekend view where we bring you the latest insights and trends in real estate investments. I'm Ashley Shoemaker. This week, we check in on the state of interest rates and their potential to impact commercial real estate markets. To kick things off, let's establish the basics. Interest rates, set by the Federal Reserve, are a powerful tool influencing economic activity. When rates are high, borrowing becomes more expensive, which can cool off overheating markets. Conversely, low rates make borrowing cheaper, stimulating investment and spending. In the realm of real estate, interest rates directly affect property values. High rates can lead to decreased demand in homeownership as mortgage payments become more expensive, resulting in more rental demand. This often results in a cooling of property prices. On the flip side, lower rates can increase demand for properties, pushing values up. But why does this matter to investors and homeowners alike? Well, understanding this relationship helps in making informed decisions about buying, selling, or refinancing properties. As of March 2024, we're observing an interesting scenario. Given the importance of interest rates in the market, investors try to anticipate the Fed's move. Looking at the SOFR forward curve, which shows investor expectations of interest rates, the Federal Reserve is anticipated to start cutting interest rates in June, with several cuts expected throughout the year. From another angle, the Fed dot plot, which shows each Fed governor's expectations, shows year-end rates at around 4.5%. All told, unless there were to be a significant change in economic conditions, the Fed will get there eventually. This shift follows a period of high rates aimed at controlling inflation. For real estate investors and homeowners, this is significant. Lower interest rates could lead to increased demand for properties, potentially driving up values. However, this isn't a one-size-fits-all situation. Market conditions, location, and property type also play crucial roles. So what does this mean for you? For investors, lower interest rates could present opportunities for purchasing properties at more attractive financing rates. However, factors such as location, property type, and market dynamics could dampen these effects. For instance, properties in sectors with strong demand, like multifamily housing in growth areas, may continue to appreciate or maintain their value due to their income-generating potential. Additionally, investment strategies that focus on value-add opportunities or developments in undersupplied markets can still offer significant returns, despite higher interest rates, by capitalizing on these market dynamics. It's crucial for investors to adapt to market shifts, remain informed, and strategically prepare for future rate fluctuations. This preparation includes understanding the broader economic implications of rising interest rates, like the Federal Reserve's response to inflation and how it impacts rental rates and demand for commercial properties, as we've previously mentioned. Caution is key. While lower rates can spur market activity, they can also lead to overheated markets. It's essential to evaluate properties based on their intrinsic value and not solely on financing conditions. EquityMultiple's investment team has capitalized in this high interest rate environment and is focused on multifamily properties in high demand and high growth markets, as well as development opportunities in undersupplied markets. Be on the lookout for our upcoming multifamily portfolio, offering diversification through a single investment. The underlying assets showcase a timely asset class, but differ in terms of business plan, sponsorship, location, and capital stack position, which helps to diversify risks in the portfolio. If you have any questions, as always, please reach out to us at ir@equitymultiple.com. See you next week.
This communication is not to be construed as an offer to sell or the solicitation of an offer to buy any security or provide investment advice. Any such offer or solicitation can only be made by means of the delivery of a confidential private offering memorandum. To the extent that performance information is contained in this podcast, past performance is not necessarily indicative of the future results, and all figures are estimated and unaudited unless otherwise noted.